Did you know that one cold Saturday in January 1951, a 20-year-old Warren Buffett took a train to Washington, D.C., and that single trip might have changed the entire course of investing history?
That's a bold statement, but I think I know where you're going with this. You're talking about his visit to GEICO, right?
Exactly. It wasn't just any visit. It was the moment Buffett met Lorimer Davidson, the man who would open his eyes to the incredible potential of the insurance business. And honestly, without that meeting, Berkshire Hathaway might not even exist as we know it today.
It's fascinating to think about how much of Buffett's career can be traced back to that one decision to show up unannounced at GEICO's headquarters. But let's back up for a second. What led him to GEICO in the first place?
Well, it all started at Columbia Business School. Buffett was studying under Benjamin Graham and David Dodd, two legends in the world of investing. Graham, of course, was the father of value investing, and Dodd was his close collaborator. Buffett wasn't just a student in their class, he was the standout. He'd already read their books, Security Analysis and The Intelligent Investor, and he was constantly engaging with them in class.
That's right. He wasn't just sitting in the back taking notes. He was actively participating, asking questions, and even turning lectures into discussions. It's no wonder his classmates sometimes felt like they were just spectators in a conversation between Buffett and the professors.
And because of that, he earned their respect and mentorship. David Dodd, in particular, took a liking to Buffett and even invited him over for dinner. But what's really interesting is how Buffett took what he learned in the classroom and applied it in the real world. He started analyzing the stocks held by Graham Newman Corporation, trying to understand their investment decisions.
And that's when he discovered GEICO, right? It wasn't even mentioned in security analysis, and it didn't seem to fit Graham's usual criteria for stock selection. But Graham Newman had a significant stake in the company, and Graham himself was the chairman of its board.
Exactly. That piqued Buffett's curiosity, so he decided to dig deeper. He looked up GEICO in the Moody's manual and saw that Graham Newman had bought half the company's shares in 1948. But he didn't stop there. He wanted to see the company for himself, so he hopped on a train to Washington, D.C., without an appointment or even a plan.
That's such a classic Buffett move, isn't it? He didn't wait for an opportunity to come to him. He went out and created one. And when he got to GEICO's headquarters, the only person there was Lorimer Davidson.
Davidson was GEICO's investment manager at the time, and he initially planned to give Buffett just 5 minutes of his time. But once they started talking, those 5 minutes turned into 4 hours. Davidson quickly realized that this young man wasn't just curious. He was incredibly knowledgeable and asking all the right questions.
And those questions weren't just surface level, were they? Buffett wanted to know about GEICO's competitive advantages, its business model, and its growth potential. Davidson must have been impressed by how much Buffett had already figured out on his own.
He absolutely was. And Davidson didn't hold back. He shared everything he knew about the insurance business. He explained how GEICO's model of selling directly to low-risk customers, like government employees and military personnel, allowed it to operate at a profit even before considering investment returns.
That's such a powerful insight. Most people think of insurance companies as just collecting premiums and paying out claims, but Davidson helped Buffett see the bigger picture. By collecting premiums up front and investing that money, GEICO could generate significant returns.
And that's when Buffett had his aha moment. He realized that an insurance company isn't just a business. It's a source of low-cost or even negative-cost capital. In the hands of a skilled investor, that capital can generate enormous returns.
It's amazing to think how much of Buffett's later success with Berkshire Hathaway can be traced back to that single meeting. Davidson essentially gave him the blueprint for building an insurance empire.
And it wasn't just about the business model. Davidson also shared some hard-earned lessons about investing, like the dangers of leverage and short selling. His own experience with shorting RCA stock in 1929 was a cautionary tale that stuck with Buffett.
That story is such a perfect example of how even a correct judgment about a stock being overvalued can lead to disaster if the timing is off. Davidson shorted RCA somewhere between $300 and $400, only to watch it climb to $574 before the crash. By the time the stock finally plummeted, he'd already been wiped out.
And that's a lesson Buffett has reiterated throughout his career. He's said repeatedly that short selling is incredibly difficult, not because it's hard to identify overvalued stocks, but because it's almost impossible to predict how long a bubble will last or how high it can go before it bursts.
It's a humbling reminder that the market doesn't operate on anyone's timetable. As Buffett likes to say, Mr. Market is insane, and trying to outguess insanity is a losing game.
That's why Buffett and his partner, Charlie Munger, have always emphasized the importance of patience and discipline in investing. They focus on buying undervalued assets and holding them for the long term, rather than trying to time the market.
And that approach has served them well, especially in the insurance business. By maintaining a disciplined underwriting process and focusing on low risk customer segments, companies like GEICO have been able to generate consistent profits and expand their float.
Speaking of GEICO, its success wasn't just about good underwriting. The company's founders, Leo and Lillian Goodwin, were visionaries in their own right. They identified a niche market, government employees, and built their business around serving that market efficiently and cost effectively.
Their strategy of bypassing insurance agents and selling directly to customers was revolutionary at the time. It allowed them to cut costs and offer lower premiums, which in turn attracted more customers. It was a virtuous cycle.
And Davidson played a crucial role in taking GEICO to the next level. He not only helped secure Graham Newman Corporation's investment in the company, but also brought his Wall Street expertise to bear on its operations.
That's one of the things I find most impressive about Davidson. He wasn't just a great salesman or a shrewd investor. He was someone who truly understood the mechanics of the insurance business and how to leverage them for maximum advantage.
And he passed that understanding on to Buffett during their marathon conversation in 1951. It's no exaggeration to say that Davidson laid the foundation for what would later become Berkshire Hathaway's insurance empire.
It's amazing to think how much of Buffett's career traces back to that single meeting. Davidson didn't just share his knowledge, he sparked a vision in Buffett that would guide him for decades to come.
And it's a vision that's still paying dividends today. By combining the principles of value investing with the unique advantages of the insurance business, Buffett and Munger have built something truly extraordinary.
It's a testament to the power of mentorship and the importance of being open to learning from others. Even someone as brilliant and driven as Buffett needed a Davidson to help him see the bigger picture.
Absolutely. And it's a reminder that success in any field is rarely a solo endeavor. It's the result of curiosity, hard work, and the willingness to learn from those who've come before you.
Well said. And in Buffett's case, it's also the result of a lifelong commitment to principles like patience, discipline, and the relentless pursuit of value.
Principles that were shaped, at least in part, by a cold Saturday in January 1951. It's amazing how a single day can change the course of a life. And in this case, the course of investing history.
It really is. And it makes you wonder how many other transformative moments are out there just waiting for someone curious enough to seek them out.
Absolutely. And what strikes me is how this story sets the stage for the next chapter. Because as much as Buffett learned from Graham's principles, Graham himself was about to make a decision that seemed to defy all of those principles. Right here in the very company we've been talking about, GEICO. Should we dive into that?
Let's do it. It's one of the greatest twists in value investing history.
Benjamin Graham, the father of conservative, rule-based investing, went all in on GEICO in a way that broke nearly every rule he taught, and even broke the law. It's a wild story. It really is. And what makes it even more interesting is that this decision didn't just break his own rules, it also broke the law. Graham's firm, Graham Newman Corporation, wasn't legally allowed to own more than 10% of GEICO's equity. The SEC actually forced him to unwind the trade. Can you imagine the stress of that? Exactly. And what makes it even more interesting is that this decision didn't just break his own rules, it also broke the law. Graham's firm, Graham Newman Corporation, wasn't legally allowed to own more than 10% of GEICO's equity. The SEC actually forced him to unwind the trade. Can you imagine the stress of that?
It's almost like a movie plot. But here's the kicker. Despite all the rule breaking and legal headaches, this investment turned out to be the most profitable of Graham's entire career. By the time he retired from GEICO's board in 1971, the company's market value had grown over 200 times from his initial investment. That's just staggering.
It really is. And it's not just the numbers that make this story so compelling, it's the ripple effects. This one investment planted seeds of doubt in the minds of Graham's followers, including a young Warren Buffett. It challenged everything they thought they knew about investing.
Right, and for Buffett, it was a turning point. At the time, he was still fully committed to Graham's cigar butt approach, buying undervalued companies, squeezing out the last bit of value, and then moving on. But the GEICO story, along with other experiences, eventually led him to develop his own philosophy, one that focused on quality businesses with strong competitive advantages.
And what's so fascinating is how gradual that shift was. In the early days, Buffett was still very much in Graham's shadow. He even sold his own GEICO shares after a 50% gain, thinking he'd found a better opportunity elsewhere. But over time, he started to see the limitations of the cigar butt approach.
It's almost like watching a student outgrow their teacher. And you can see how Buffett's experiences at Graham Newman played a big role in that evolution. Take the Philadelphia and Reading Coal and Iron case, for example. It was a classic cigar butt investment, a dying business with valuable assets. But what Buffett learned from that deal went far beyond Graham's principles.
Oh, absolutely. That deal was a light bulb moment for Buffett. He saw how Graham and Newman used P&R's cash to acquire Union Underwear, the company behind Fruit of the Loom. It showed him that a struggling business could be transformed by acquiring a promising one. That idea would become a cornerstone of Buffett's strategy at Berkshire Hathaway.
And it's not just about the strategy, it's about the mindset. Buffett started to realize that focusing on short term gains and undervalued assets wasn't enough. He needed to think bigger, to look for businesses with sustainable competitive advantages, or what he later called moats.
And that's where Charlie Munger comes in. Munger, Buffett's longtime business partner, was a big advocate for buying great businesses at fair prices rather than mediocre ones at bargain prices. Together, they created a strategy that combined the best of Graham's teachings with their own insights.
It's such a powerful example of how knowledge evolves. Graham laid the foundation, but Buffett and Munger built something entirely new on top of it. And the results speak for themselves. Berkshire Hathaway is now one of the most successful companies in the world.
But what I love most about this story is how it reminds us that even the greatest minds aren't infallible. Graham made mistakes. Buffett made mistakes. But they learned from them, adapted, and kept moving forward. And that's a lesson we can all take to heart, whether we're investors or not.
Couldn't agree more. It's a story of persistence, adaptation, and the courage to challenge even your own beliefs. And at the end of the day, isn't that what growth is all about?
It really is. So, what's the big takeaway here? For me, it's that the best opportunities often come from looking beyond the rules and seeing the bigger picture. Whether it's investing or life in general, sometimes you have to take a calculated risk to achieve something extraordinary.
Couldn't agree more. It's a story of persistence, adaptation, and the courage to challenge even your own beliefs. And it leads beautifully into our third story, another moment where Buffett proved that breaking away from the textbook can be incredibly profitable, even when it meant going against Graham's own instructions. I'm talking about the cocoa bean arbitrage.
That's such a classic. Warren Buffett, the man synonymous with value investing, once made one of his earliest fortunes not by sticking to the rules, but by actively breaking away from his mentor's advice. It's wild to think about. Here's Buffett, just a few months into his job at Graham Newman, and he's handed what seems like a straightforward arbitrage opportunity. But instead of just executing the plan, he digs deeper and realizes there's a much bigger play here.
And the setup for this whole thing is so intriguing. You've got this old chocolate chip manufacturing company that's being sold because the major shareholder wants out. On the surface, it looks like a standard deal. But hidden in the company's inventory is this massive pile of cocoa beans, bought at rock bottom prices back in the 1940s.
It's wild to think about. Here's Buffett, just a few months into his job at Graham Newman, and he's handed what seems like a straightforward arbitrage opportunity. But instead of just executing the plan, he digs deeper and realizes there's a much bigger play here.
And the setup for this whole thing is so intriguing. You've got this old chocolate chip manufacturing company that's being sold because the major shareholder wants out. On the surface, it looks like a standard deal, but hidden in the company's inventory is this massive pile of cocoa beans, bought at rock bottom prices back in the 1940s.
Right. And by the 1950s, those cocoa beans were worth a fortune. Prices had jumped from 5 cents a pound to over 60 cents a pound. But the company couldn't just sell the beans and cash in. Their business model relied on long-term contracts and stable pricing, so they couldn't risk alienating their customers by suddenly raising prices.
And then there's the tax issue. Even if they did sell the beans, they'd face a corporate tax rate of 52%. That's more than half the profit gone. So the wealth was there, but it was essentially locked up, and no one could figure out how to access it without losing most of it to taxes.
Enter Jay Pritzker. This guy was only in his early 30s at the time, but he was already showing the kind of brilliance that would later make him a billionaire. He found a loophole in the tax code that allowed companies to distribute inventory tax-free if it was part of a business segment liquidation.
And that's exactly what he did. He bought the company, announced that he was shutting down the cocoa butter line of business, and allocated the 13 million pounds of cocoa beans to that segment. Then, he used those beans as part of a stock repurchase plan, essentially giving shareholders the option to exchange their shares for cocoa bean receipts.
This is where Buffett comes in. Graham saw an arbitrage opportunity here. Buy the stock, exchange it for the cocoa bean receipts, sell the receipts for cash, and pocket the $2 per share premium. It seemed like a no-brainer, and he assigned Buffett to execute the trades.
But Buffett, being Buffett, couldn't just leave it at that. As he dug into the numbers, he realized there was a much bigger opportunity. The company's cocoa bean inventory alone was worth far more than the stock price. And as more shares were repurchased and canceled, the remaining shareholders' stakes in the company and its assets would become even more valuable.
So instead of just following Graham's instructions, Buffett decided to use his own money to buy and hold the stock. He figured that as the market started to catch on to the hidden value in the company, the stock price would soar. And he was absolutely right.
The stock eventually climbed to nearly $100, and Buffett sold his shares for a profit of about $13,000. That was a huge sum for him at the time, more than 200% return on his investment. And the best part? If he had stuck to Graham's method, he would have made just $444 on those same shares.
It's such a powerful example of how thinking independently can lead to extraordinary results. Buffett wasn't just looking for a quick, risk-free profit. He was looking at the bigger picture, considering all the variables, and making a calculated bet on what he believed to be true.
And it wasn't just about the money. This experience taught Buffett some invaluable lessons about arbitrage, about tax strategies, and about the importance of trusting your own judgment, even when it means going against someone as respected as Ben Graham.
What's even more fascinating is how this story ties into Buffett's broader philosophy. He's always been about finding value where others don't see it, whether it's in a pile of cocoa beans or a company's long-term potential. This was one of the first times he really put that philosophy into practice.
And let's not forget Jay Pritzker. His role in this story is just as compelling. This was a guy who turned a $95,000 loan into a business empire that included over 200 companies. And his most famous acquisition? The Hyatt hotel chain, which he turned into a global brand.
The story of how he bought the Hyatt near LAX is legendary. He was having coffee at the hotel, noticed it was fully booked, and decided to buy it that very afternoon. That kind of decisiveness and vision is rare, but it's exactly what made Pritzker so successful.
And his reputation for integrity was just as important as his business acumen. People in financial circles trusted him completely. They said you could play poker with him over the phone and not worry about being cheated. That kind of trust is invaluable, especially in high-stakes business deals.
It's no wonder Buffett admired him so much. Even decades later, when Berkshire Hathaway acquired a majority stake in the Marmon Group from the Pritzker family, Buffett spoke highly of Jay. He even mentioned that the deal was done in a way Jay would have loved, based purely on trust and financial statements, with no investment bankers or due diligence involved.
That kind of relationship is almost unheard of today. It's a testament to the power of reputation and the importance of doing business the right way. Jay Pritzker's legacy isn't just about the wealth he amassed. It's about the way he conducted himself and the values he upheld.
And that brings us back to Buffett. The lessons he learned from this early encounter with Pritzker clearly stayed with him throughout his career. Whether it was about tax strategies, the value of trust, or the importance of thinking independently, those early experiences shaped the investor and the person he would become.
And that brings us full circle. We've traveled from a cold Saturday at GEICO, through Graham's rule-breaking bet, to this brilliant cocoa bean deal. 3 stories, but one common thread: the greatest rewards don't come from blindly following a formula. They come from showing up, asking the right questions, challenging the rules when the facts demand it, and having the courage to think for yourself.
Beautifully said. Whether it was Buffett knocking on GEICO's door unannounced, Graham betting big against his own textbook, or young Buffett trusting his own analysis over his mentor's playbook, each moment reminds us that independent thinking is the real edge. And the people they learned from, Davidson Pritzker, prove that integrity and vision are just as important as intellect.
So as we wrap up, here's our takeaway. Stay curious, stay humble, and never stop looking for the value that others overlook. It's a philosophy that built Berkshire Hathaway, and it's one that can guide us in our own decisions, whether we're investing or not.
Thanks for joining us on this deep dive through 3 turning points in investment history. Until next time, keep asking questions. You never know where a single Saturday train ride might lead.